So nice to see you all again here in Borlänge. I'm going to talk about two cases of financial instruments, let's say that, the venture capital mezzanine and the Jeremie case. Let's begin with the venture capital. When we talk about venture capital, it means financial instrument and further a financial institution that gives money to a company, which company either cannot have money from other sources or does not want to get money from other sources. In the case of venture capital, the venture capital financial institution, which usually is an affiliate of a bank, gives the demanded money to the company, and it takes as a counterparty a part of this company. So we talk here about equity. The venture capital gives the money and quite probably participates also to the board of directors. That means that the venture capital does not give only money, but is very much interested on the growth of the company, because the goal, the target of the venture capital is the growth of the company, and for after a time period, usually of 5 years, to sell the equities they received from the company to a very much bigger price and take the profit and leave the company. Usually they sell the stocks either to the old owners of the company or to the new owner, to new investors who want to get in the company. There are several stages in which a venture capital can participate to a company. We have the first stage during which either we have an idea for a scientist, for example, who has a very good idea that can be transformed to a product. In this case, we have no company, we just have an idea. This is a very risky case, and if it works, it's also a very profitable case. In the same almost case, we have the beginning of the company. We don't have a real production, or we are just at the beginning of the production. In this case as well, we have a very high risk. We have an intermediate case in which we have the company that always exists, has a network, produces, and needs money to grow up. And we have a third case in which we have a mature company that wants to get public. We have in this case the mezzanine or the bridge case. The two last are the less risky cases. That's why they receive more of money. If we want to talk a little bit about the mezzanine, usually this is the last round of the investor, in which the investor gives money to a company that wants to get public and usually wants to go to the stock market. It can be combined by a debt and the equity. The investor has a case in which there is no big risk. On the contrary, it's a case of low risk. The profit is not as big as in the case of the startup or the first stage. And usually is in the case where the company wants to get public, to get into the stock market. Why maybe need a financial institution that can be the venture capital? For several reasons. One is to get money just before grow up and go get public. The second is that having beside the company a financial institution that is very important for the company and is very important for the trusting of the public who wants to invest in a company. And we have another case that we'll see later in the table. That's why I put it here. This is the buyout. In the case of buyout, the investor takes at least 51% of the company. This is a company usually which is underevaluated, but it has potentialities. The investor takes the company, builds up again the company, and sells with much more profit. I remember the film, the movie Pretty Woman. Richard Gere, I think he did the same thing. Buying bad companies or companies in problem, fix it again the way he wanted, and sell it with profit. I have here a table that was taken from the European Venture Capital Association, and here we have, I have two tables, one indicating the amounts and the other indicating the number of funds that have been created. The time period goes from 2007 to 2013. As you can see, the buyout is the more important considering the amount invested. This is the less risky case and maybe can give a lot of profit. In the case of mezzanine, we have an important part of funds that has been given there. For the startup, there are less money investing there, which is normal because this is a very risky case. We also can see that before the crisis, if we consider, for example, 2007 and even 2008, we have a lot of money that have been invested. Just after the crisis, and during the crisis, the amount appears to get decreased very much, and we see that the last years, when we go just out the crisis, this amount begins to grow up again. If we consider now the number of funds that are interested there, according to the European Venture Capital Association, we have some slight differences. We see that, for example, we have a good number of funds that invest on early stage and balanced cases. That means that we have less funds in comparison to the amounts for the big cases as buyout and mezzanine. That means that we have exactly a small number of funds that invest a lot of money, which is normal. As we'll see later, on the early stage, less money are invested. On the contrary, on the mature cases, much more money are invested. Considering the evolution of the number, we have a similarity to the amount of funds invested. We have a lot of funds that are at the beginning, before the crisis. We have a decrease, a continuous decrease of number of funds during the crisis. The two other tables show this, the evolution as percentage. I don't think we are going to insist on that. Now, I go to the second part of my presentation, which is the Jeremie. Jeremie is one of the four initiatives undertaken by the European funds. Let's begin with the three others. We have the Jasmine. Jasmine is interested to microfinance. We have Jasper, that is the support for the European regions. And we have Jessica, which is interested to the support of the city areas. And then we have the Jeremie. Jeremie is the acronym of the European Resources to Micro and Medium Enterprises. So, Jeremie gives money to small and medium enterprises, but it's not directly from the Jeremie that SMEs receive this money. Let's begin how the assistance is provided from the Jeremie. The money comes from the European Regional Development Fund. And the money that has given is either as a loan or a guarantee or venture capital funds. We'll see later how it goes. I have here a table of the cases of the money that is given through the Jeremie. As you can see here, in the vertical, we have how much money is given. We don't have numbers, but you can see here we're approaching to zero, and then growing up, we have much more money. So what happens here is in the pre-seed, seed, and startup cases that concern technology transfer, business angel funding, microcredit loans, we don't have so much money given. These are very high-risk cases. Going to the development or growth or mature cases in which we have a lower risk and that concern the funded risk-sharing products, the private equity, and the guarantees and credit enhancement. In those cases, we don't have so much risk. We see that much more money are given. Those money are given through the Jeremie initiative. How does it work? Jeremie is an umbrella and targets to financial intermediaries, not to SMEs directly. That means that we have a holding fund that gives money to financial intermediaries, and those financial institutions give the money to SMEs that are interested. Let's go just to a table to move on quickly. I have here the number of countries that have been profited by the Jeremie. We have 17 countries. The number of holding funds, we have 41. And without the participation of the European Investment Fund, we have 11 funds. And then we have the amount that has been dedicated in 2010, which is 3 billions and a half from the European Regional Development Fund. And I have another table that is in 2013 that indicates in country cases how it goes. We see, for example, that Greece and Romania and Bulgaria especially profited more from the Jeremie cases. And we see that money is given to equity, is given to guarantee, and is given to risk-sharing products. And for 2013, we have about 2.6 billion money that is given there. What is important in the case of Jeremie is the catalyst amount that means that the Jeremie Fund gives an amount that is completed by the fund that is given by the other financial institution as well. It's not only this money that is given. Because of this money, other money of other financial institution is given as well. That means that if I want to make an invest, I receive money from the Jeremie initiative, but I need more money to make my investment. So having the Jeremie part of this investment, another financial institution or either me is easier to complete the amount needed for the investment. This is the catalyst case that we have in the case of Jeremie. And here I have just an example of Jeremie that I found in the internet. You see that you have, in the case of Bulgaria, you have an institution that is the Raiffeisen Bank that plays the role of the holding fund in the case of Bulgaria, that takes another part of another group of other banks and together manage, in the case of Bulgaria, the Jeremie in Bulgaria. So we have the Jeremie that gives money to a financial institution that takes the role either of a holding fund or specific funds. Those funds takes the money and gives the money to SMEs. This money that is given is part of the investment. The other part of investment is funded by other institutions. Thank you. You completed this. Thank you very much.